All right, let's get started. Good evening and welcome to the YD Wealth webinar. We are delighted that you are here with us tonight and choosing us over the Blue Jays game. Before we begin, I have a few housekeeping items to go over. This presentation consists of two parts. The first will be a presentation that I will walk us through, and then there will be a Q&A segment where Alan and I will address your questions. Now, for privacy reasons, your cameras and microphones are turned off, so we're unable to see you and we can't see and hear you. So in order for you to interact with us, we ask that you open the little Q&A box up in the top right corner of your screen. Once you have that open, you'll be able to type in your questions and comments, and we'll see them and be able to address them. And rest assured that your comments and questions are posted anonymously. So, and for those who can't attend, today's session will be recorded and will be sent out later. So with that said, I'm now going to ask Alan to come on and give us a brief introduction. Alan, over to you.
Good evening, everyone. Thanks so much for attending. And as Ethan said, we changed the time from our first webinar from 4 o'clock to 5 o'clock, thinking more people could attend. And I hope you've set your recording devices for the Blue Jays game. I know I have, should be exciting. But thanks again for joining us to talk about this topic today, which is really about managing risk. And so really the goal here today is to explain how Ethan and I use asset allocation to make your financial journey as smooth as possible. And asset allocation really is the greatest tool to provide a smooth ride for you. And that's really part one is how do we set up that asset allocation? And part two is also then how do we trade tactically in order to make the ride even smoother and perhaps even pick up some return for you along the way. And so these are the day-to-day events that Ethan normally is in charge of. Before I forget, I do want to thank him, both Ethan and Harpriya for setting up the event today. A lot of work went into it. Also team member Carmen. All four of us are here today and looking forward to answering your questions and filling you with information that you need to hear. So with that, I'll pass it over to Ethan for the presentation. I'll be handling your questions. To repeat, they are anonymous, so do pose them, and then we'll look to handle some of the questions at the end of the webinar. Go ahead, Ethan. Thanks again, everyone. We'll see you at the end.
All right, thank you, Al. So we titled this webinar, Invest Like Harvard, Institutional Caliber Portfolios. Our goal this evening is to show you how institutions like Harvard invest and how we use the same approach and mindset in managing your money. Now, when I refer to Harvard, I'm talking about the Harvard Endowment Fund. It's currently the largest university endowment fund in the world, sitting at about $60 billion as of 2024. One thing that if you don't know already is that the Harvard Endowment Fund is a critical part of the university's operation. Every year, Harvard draws about 5% from its fund to support its operations and ensure that the university is funded properly. So from that perspective, Harvard's endowment fund it is critical that they generate very consistent and smooth returns in order to support the university's needs and purposes. Now, before I move on, I would like to just do a couple highlights of our professional profile for those who don't know. When you see the term portfolio manager that Alan and I have, it signifies the highest level of licensing in our industry. It basically means that we have fiduciary duty to act in our client's best interest, just like a doctor and a lawyer would. With respect to our day-to-day, we had mentioned in the past that Alan is the lead for relationship management. He talks to a lot of our clients, whereas I'm more behind the scenes. I lead the money management aspect of our practice. So from that perspective, the CFA is the most relevant in terms of the work that I do. In short, the CFA requires about 10,000 hours of training in both exams and work experience to obtain. So I would equate it to similar to being like a pilot going through training to be able to fly a commercial plane, or a resident going through a residency program in medical school. So just wanted to give you a bit of color on those things. Now here's a bit of disclaimer for us. It basically says that the content of this webinar is generated by our team, YD Wealth Partners, and not by Richardson Wealth. So since we're talking about Harvard, I thought it would be fitting to share a few of my memories of Harvard with you. These pictures were taken a few years ago when Han and I visited the campus. So Han, my partner, is a cardiologist, and she was beginning her graduate studies at Harvard at the time. So these pictures were taken during our initial visit. So here's me pretending to be a student. And on this particular trip, we had the pleasure of staying in the student dorm. So for me, it was an extremely cool experience to pretend and kind of live the life of a Harvard student for a week or so. So here's our agenda for this evening. I will do a brief market update because it has been several months since the last webinar that we did back in the spring, in the midst of the kind of the peak of uncertainty for tariffs. So I want to give you an update on that. And then we'll go into holistic wealth. We'll do a quick overview of it before shifting into investment management, which is the topic for this evening. Now, within the investment component, we'll talk about institutional caliber portfolios. We'll go over two types of asset mixes, strategic and tactical. I'm going to tell you what they are and how we use them in managing your money. Then I'll close off with some thoughts, and I'll invite Alan back for the Q&A segment. So financial markets have remained resilient in the face of ongoing tariffs and some economic uncertainty. They have recovered nicely since April's low of this year, and this strength in this recovery really is supported by expectations for interest rate cuts, which we've seen a couple even this afternoon today, strong corporate earnings, and lots of investment in AI. So our portfolios overall are doing very well. And so we just want to continue to look for opportunities for you and manage risk along the way. If you didn't get a chance to check out our last webinar, feel free to go to our website under the blog section, and then you can see what we talked about in the midst of the kind of the tariff turmoil. So here we have a description of holistic wealth, and the way I like to describe it really is it's three pillars. The first pillar that most people know about and often talk about is investment management. This has to do with wealth accumulation to achieve your desired goals. So oftentimes there are two main factors that contribute to wealth accumulation. It's savings plus portfolio growth. So assuming you have a well-diversified portfolio that gives you effective wealth accumulation, then we move on to consider financial planning, or some would call tax and estate planning. Here, we aim to create a roadmap for you and your family and consider tax optimization strategies. So how do we keep more of what we make? And then lastly, we consider insurance as a way to protect lives. So that could be life insurance, it could be critical illness or disability type insurance. So now if I was to give you an example to help you remember the three pillars here, it would be that you imagine you're flying on an airplane to your retirement destination. So you have three objectives. The first is that you want to fly there as quickly as possible through effective wealth accumulation. Then you want to fly there in the most fuel efficient manner through tax saving strategies. And then lastly, you may consider insurance because we know that life is not a risk-free journey. So hopefully that helps you. But today we're going to dive into investment management. So in order for us to be on the same page, I do want to go over a few terminology. So oftentimes, as we go through this presentation, you'll hear the word asset mix quite a bit. So what is asset mix? So it's defined as the composition of your portfolio, meaning how is your money spread amongst different asset classes such as stocks and bonds. Those are two examples to balance between return and risk. There are two types. Strategic refers to your long-term asset mix. So this is driven by your financial goals, your risk tolerance, your time horizon, etc. It's about you. So oftentimes we discover and set ourselves on a strategic asset mix for you based on your conversation that you have with either Alan or myself as your financial advisors. Your strategic asset mix can change with age as well as evolving life circumstances. On the other hand, tactical asset mix has to do with short term to medium term. It's often driven by market developments, and it has to do with actions at YD Wealth Partners that we take on your behalf when we see opportunities to either capture a discount in the market or manage risk. So it has to do with buying and selling of securities to manage around the strategic aspect of it. So going back to the airplane example that I gave you, you can then think of strategic asset mix as the thing that delivers you to your flight destination, while we as pilots on this journey are the ones that are dealing with the varying turbulence along the way with our tactical techniques. So let's start off with strategic asset mix. So we titled this Invest Like Harvard. So the natural question is, how do institutions like Harvard invest? So I first came across this type of investment approach in one of my MBA classes. That's when I learned about, institutional money management and how they think. And it really comes down to two main things. The first is that they have a long-term view. So when you think about an institution like Harvard, their time horizon is 100+ years. Whereas you and I, we have a fairly long time horizon, but it's in the decades. So maybe it's 2 decades, 4 decades, etc. So the first is we have to have a long-term view and stay invested. And secondly, and more importantly, is they create and manage globally diversified multi-asset portfolios. So we're going to unpack what this means in the next few slides. But the takeaway is that our team uses the same institutional mindset and approach in creating portfolios for you. And the benefit is that we are able to protect capital during market turmoil and participate on the upside over the long term. So here I have an example of an institutional caliber portfolio. The first thing you'll notice is that it has many different assets in it. It's not just stocks and bonds. And a few observations to share here is that oftentimes when we talk to individual investors or retail investors, they know about what's on the left side of the circle, meaning they know about real estate because they own a home. They might even have an investment property. They know about stocks because they hear it on the news. They might read it online. Their friends might talk about it. They might even know about bonds because as they get closer to retirement, they're told you have to have some bonds in your portfolio to balance out risk. What a lot of individual investors don't know about is what's on the right side of the circle, these other assets. And this is what institutions and what we look at in our approach. So in fact, if you go to the banks, oftentimes they offer you something like a balance or a growth fund. But really that only gives you access to 2 slices of this pie. Whereas in the work that we do, we include, as you'll see, many more slices of the pie as the institutions are doing as well. So first of all, then, the takeaway really is then there are many different asset classes that we can use to smartly diversify and construct more intelligent portfolios. So that's really the takeaway. So before I move on, let me just spend a couple minutes here to just briefly describe each of these other assets, so you have a brief understanding. So when we talk about preferred shares, it's really a dividend play. We own the shares to collect dividends. So they have priority over just common shareholders in receiving dividends. So in terms of their kind of priority in the capital structure, they sit in between stocks and bonds. They are less risky than stocks, but more risky than bonds. But effectively, it's a dividend play that we use in your portfolio. Then we have private debt. Private debt is a form of also income instrument, but they're less sensitive to interest rates, and they're generally higher yielding. So an example would be a mortgage fund that we could use to collect higher yield and create another income stream for you in the portfolio. Then we have private equity, which essentially is private businesses. So if you're an entrepreneur, perhaps you're like a doctor or a dentist, you have your own, your own corporation, that would be a form of private equity. One thing to note is that institutions tend to favor private equity more because they have a much longer time horizon, and they can hold on to these instruments a lot longer. Private equity usually requires 10 plus years of holding periods. They're less liquid, so that's just something to keep in mind. And then hedge funds really come in two forms. The first type is that they're meant to be more growth oriented. They're more spicy, so to speak. Some of them aim to beat the market, whereas others are more hedge fund hedge-like. So they're meant to hedge risk. They might long certain stocks, short other stocks to be able to balance out risk. And we do use both of those types in our own portfolios. And then lastly, we have commodities. So that's a big umbrella term for things like precious metal, oil, natural gas, etc. So here, I'm showing you the asset mix for the Harvard Endowment Fund as of 2024. The first thing you'll notice is that, as we spoke about, they hold many different assets, not just stocks and bonds. And in particular, they have a fairly big exposure to hedge funds, as well as private equity. So I spoke about this on the previous slide, in that institutions have a long-term, very long time horizon, so it allows them to hold on to these things to benefit for the long term. So this is something that Harvard's endowment fund has gradually moved more and more towards over the last number of years since I've started tracking them. In contrast, here are two most commonly used asset mixes for us, YD Wealth Partners. So I'm showing you our balance model as well as our balanced growth model. You also notice that we have various asset classes, just like the Harvard fund, except if you if you have an eagle eye, you'll see that we don't have any private equity in here. And that's because for individual investors, private equity is less attractive. And in particular, over the last number of years, they haven't been performing as well. So it's been a decision by our team to have more exposure to the public markets. And as you know, the public markets have done very well over the last 2-3 years here. But we do have a decent exposure to hedge funds. And then you'll see, like, as I spoke about, we have bonds, preferred shares, private debt, and some commodities. So now let me share a few observations here with you. If you look at the numbers, you'll observe that in general, we put about 60 to 70% of your money in more traditional things like stocks and bonds, and the other 1/3 in the other asset classes that we collectively call alternative investments. And also, another key insight is, how do we actually manage all these models? What is this? What is the actual technique that is used? So I want to share an analogy with you. It's kind of like cooking. Imagine you have 10 ingredients on the table and you want to make different dishes for different, for your different friends. But one of them likes it mild, the other one likes it spicy. So really, all we do is we take the same ingredients and we combine them in different proportions to make a dish that is perhaps mild versus something that's a little bit more spicy. So what that means from a portfolio construction perspective is we have a set of securities that we've done our homework on and we track day in and day out. And we use the same securities to construct these different models based on the risk tolerance of our different clients, based on their different strategic asset mixes. So this is a very elegant way to manage money and allows us to really monitor every single position. And when we make a change, we do it across the board because we just swap one position out and put another one in. And by default, this approach to managing money, this kind of institutional approach, is defensive by nature. So as an example, during 2022 or even the spring of this year, when markets were in a fairly big decline, we experienced only about 30 to 40% of the market drawdown. But when the market is down, that would allow us an opportunity to be tactical and add to your portfolio using either cash or selling, some bonds as an example and buying some equity. So by default, we're always playing defense, and then we're able to act tactically when the opportunity arises. So then you might ask, okay, we've talked a lot about this pie chart and these different numbers, but how does it actually work underneath the hood? So I want to spend the next few slides to go over something called modern portfolio theory with you and give you a bit of color in terms of how things actually work. So let's start with the basics. Here I have a two-dimensional chart that shows return and risk. So right off the bat, you'll notice that institution, money managers, and the way we do our work is that we don't just consider return. We're not just asking, a one-sided question, which is how much money am I going to make? We also consider the risk side of the equation, which is how much risk am I taking to generate that return? So if I was to give you two portfolios, portfolio A and B, and I told you that portfolio A had a 10% return and a 5% risk, and portfolio B is kind of the opposite, I would say that most rational investors would prefer to have portfolio A because you want something with a higher return and lower risk, if possible. So then as investors, our objective is to really try to move in this direction on this graph. We want to be in a position where we have a portfolio where we have a higher return with less risk, if possible. So let's see what modern portfolio theory has to say. So here I have all these little red dots. You can think of each dot as a combination of different risk assets. So when I say risk assets, I mean like stocks, bonds, commodities, all those different, pieces of the pie that we talked about. So maybe, for example, the dot down here is a portfolio of all high-tech stocks. Okay, so certainly it has higher expected return, but you're also having to take on higher risk for that type of portfolio. And to be honest, I wouldn't call that a well-diversified portfolio because it's just a bunch of tech stocks in the same category, as an example. And then maybe the portfolio down here is a portfolio of bonds. So notice that we're defining bonds to be a risk asset as well, because when interest rates go up, bond prices fall. So bonds are not risk-free. So it turns out that according to modern portfolio theory, no matter how you combine the different assets, all portfolios are bounded by something called the efficient frontier. And a portfolio out here shown in yellow is unattainable. So we basically say that there are no free lunch in investing. If you want a higher return, you have to be able to absorb a higher risk. But notice that this curve, the efficient frontier, curves in the direction that we spoke about earlier. It's actually leaning towards the upper quadrant here. So that's good news. There's actually some magic happening here. And what this implies is that if we diversify and construct portfolios intelligently, we are able to bend this curve to create a better risk-adjusted return. What do I mean by that? If this line was actually straight, imagine there was another line here that was straight, it would imply that it would be a linear trade-off between return and risk. But because this is a curve, we're now able to, let's pick an example. Let's say we wanted this return. We're now able to achieve this return with less risk versus if it was a straight line, the line would have been here. So this is the magic in portfolio construction. It's combining assets properly to be able to get closer to this curve to give us a better risk-adjusted return. So as I spoke about earlier then, based on our conversations with you, and your time horizon and your risk tolerance and your unique circumstances, we would then place you or any other investor somewhere along this curve based on their strategic asset mix. So now let me go one level deeper and talk about a concept called correlation and what it means and how that translates to the volatility for a portfolio. So imagine I have two asset classes or two stocks that are affected by the same economic input. So let me give you an example. Maybe one curve here is Canadian equity, the other is US equities. So they're both equities. They're going to be affected similarly by same economic inputs, and their outcome will be similar. They may not move up and down exactly, but they will be quite similar through time, like dolphins swimming in an ocean. So when we have this type of behavior, we call it positive correlation. And when we combine the two, we get the effect on the bottom, which is to say, times can be good, but when times are bad, it really magnifies the volatility in your portfolio and causes stress. And for some people, it basically causes sleepless nights, or they can't hold on. They can't stay invested. They want to get out of the portfolio because maybe they're holding all tech stocks, they're all holding bank stocks, and when things turn for a particular sector, it really hurts them. So in this example here, volatility can really hurt your long-term wealth accumulation. Whereas on the right, it's a different theory and a different way of thinking. This is what modern portfolio theory proposes. It's asking the question of, can we find different assets or securities that are not positively correlated? So meaning they're negatively correlated. They move up and down at different points in time, but they will grow with the economy and they'll grow with technological advances over time. So an example of that would be perhaps stocks and bonds. Those are two traditional asset classes, or maybe a growth and a value stock. When we're able to do that in portfolio construction, we have the combined effect on the bottom, which reduces volatility. So with that, then, we're able to have a smoother and a more consistent experience through time. We're able to remain invested and benefit from the power of compounding. So now let me show you an example numerically of how volatility can destroy or hurt wealth accumulation over the long term. Here I have an example of two people. We have consistent Christine. She gets 8% a year for the next 10 years. So some would say she's boring, but hey, she's consistent. Then we have Jumpy Jeff. He has really good returns for the next 2 years. For the first 2 years, he has a negative year, but overall, he looks pretty good too. He has really high returns, and over the last, the next 10 years, he really only has 3 negative years. In fact, if you were to add up the return series for both of them and divide by 10, it turns out that they each get 8%. So that's the simple average. If you simply don't consider compounding, add it up, divide by 10, it appears on the surface that they have the same simple average. But look at what happens when we consider the effect of compounding and volatility through time. If they start with $1 million, it turns out that consistent Christine comes out ahead at the end of 10 years by over $300,000. So let that sink in. Volatility here hurts long-term wealth accumulation. And institutions know this, and we know this, and that's why we practice and do our best to deliver the consistent returns that we do. In fact, if you think about what happened with Jumpy Jeff, if you get a negative 20% near or during your retirement, it can be detrimental to the quality of life during your retirement. So the takeaway is we want to practice and be as close and be like consistent Christine in our approach. And that allows us to sleep better at night and stay invested. So in summary, the key takeaways here are we want to diversify efficiently using non-correlated assets. We don't want positive correlation. That allows us to reduce the volatility of the portfolio. And the benefit is that it increases our long-term risk-adjusted return. So now let's shift gears and go into tactical asset mix. I mentioned earlier that it's often driven by market developments. It involves daily monitoring of the markets as well as your portfolio positions that we do on your behalf. We leverage a tool called InvestNet, which is a portfolio management tool to allow us to act in a nimble fashion, as well as being able to execute trades efficiently and consistently across the entire practice. Here I have a couple screenshots from InvestNet itself. I wanted to share a couple of these features with you to just give you that color and that perspective. The first one on the left is what we call a rebalance. So it's a feature that allows us to take a particular account or a series of accounts and trade it back to the model. I said earlier that we run a particular model, so it has a number of positions and it has these position weights and percentages. Well, over time, as the markets move, your positions in your account can drift away from the model. So effectively, we can use this feature called rebalance to snap your account and the positions within it back to the model. But effectively, what this allows us to do is to sell positions that have drifted above the model weights, meaning they're in profit. So we're able to sell high, take that profit, and buy it back, put that money, and buy positions that are temporarily underweight, meaning they have underperformed with respect to into the model. So what really the way to understand this is it's a feature that we use, it's a function that we use to be able to sell high and buy low through time. And then on the right, I have an example where we're doing what I would call a swap trade. Just give me one moment here. I noticed that the slide disconnected, so I'm just going to reshare. So please bear with me. Okay, I think we're back online. Can someone give me a hands up on that?
Ethan, Alan here. I see the slides now. Should be okay.
Okay. Yeah, don't know what happened there. Sorry about that. But all good. So as I was saying, the one on the right allows us to do what I call a swap trade, meaning maybe in certain instances, I'm not interested in rebalancing the whole account or the whole model. I'm just interested in making a swap. So in this particular example, with this feature, I'm selling 100% of the Bank of Nova Scotia and rolling all those proceeds into TD Bank. So here I can affect this particular swap trade either for one account or a series of accounts across the practice. So now let me share a couple examples of more recent tactical trades that we've done. The first one here is XEQT, which is a global equity ETF. Here I have a 1-year chart. So in this chart, every bar that you see here is 1 day. For this particular trade, we initiate the position on April the 7th, right in the midst of the tariff turmoil. And in fact, with our preparation and leveraging InvestNet, we were able to enter this position right at the bottom of the market. So on April 7th was the bottom of the market, and then 2 days later on April 9th, Trump announced a pause on the tariffs. And so we've seen a really strong recovery since then. And then we've held this position all the way out until October 8th, which was a couple of weeks ago when we decided to de-risk and take some profit. So we sold the position at about a 30+% profit and rolled it into a less risky position just to de-risk. So here's an example where a tactical trade lasted for about 6 months. On this next example, KWeb, which is China technology, I have a 10-year chart. So in this case, every bar is 1 week instead of 1 day. So it's a much longer time frame. And here I want to illustrate that in this particular case, this tactical idea could be in the order of a few years instead of a few months. So as you can see here, China technology did do very well in the past, but because of the Chinese real estate bubble, that kind of dragged the entire real estate market down, as well as the financial markets down, along with a lot of political tension between the US and China. China technology has really declined and trading at a huge discount in the last few years. So based on our homework, we've been really accumulating in this position over the years of the last couple of years, 2023 to 24, under the thesis that the technology sector as a whole within China is trading at a huge discount relative to the US counterparts. And in fact, right now there's a lot of investments and hype in AI. And from the work that I've done, all the US models are very competitive, but the Chinese AI models are almost on par. And yet the technology companies there are not getting the benefit of the doubt from investors. So, people are still a bit shy to get back into China. So it's, required a bit of patience, but what we're seeing in 2025 is that this play is starting to come alive. So in 2025 alone, K-Web is up about 40% versus US technology, which is up about maybe 22, 23. So despite all that you hear in the news with US technology, China technology is actually almost double of that so far in 2025. So if this thesis continues to play out, we expect to be in this trade for some time and be able to profit from more of it as it recovers. So that is our second example. So in closing, I want to emphasize the fact that we use a structured and disciplined institutional approach in managing your wealth, as you have seen. Your portfolios are well diversified and well structured to not only capture opportunities, but to protect capital on the downside. And we aim, and we will continue to aim, to deliver smooth and consistent return for you. And if I was to go back to the pilot example, the airplane example, I'd like to say that we're the pilots on this journey, and you are our passengers. So we thank you for your trust in us, and we hope that your ride has been pleasant so far. So with that said, I'm now going to invite Alan back to begin the Q&A session with me.
All right,
So
here I am.
1 second
yes.
here, Alan, I'm going to send you live.
Okay. All good. Thanks, Ethan. That's great. Content was excellent, and hope everyone enjoyed hearing a little bit more about how we're running your portfolios for safety. We've had a couple of good questions. The first one that came across here that I will speak to is, what is our current portfolio exposure to AI-related stocks? I think the safest way to answer this is that AI-related stocks, of course, are more closely tied to technology, and technology, I have to say, is one area of the portfolio that forms the more aggressive piece. Of course, you heard Ethan talk about spreading your assets around to different places. Most importantly about AI, when I come to comparing it to my long career, I have been in this industry long enough to remember .com back in the year 2000, and what we learned from that time frame is just how technology and the mistakes that were made became too much of people's portfolios. I like to think back to BCE and Nortel, and I looked at people's RRSPs owning sometimes 50, 60, 70% of their account in these tech-related stocks, and even just Nortel directly. We're not going to make that mistake again. Ethan just alluded to, back to the AI-related stocks, K-Web would be definitely the technology holding that holds the most AI, and we've decided that participating in AI in China is less expensive than direct investment in the NASDAQ, and that's proved profitable. As Ethan showed, we've had double the return from KWeb as we would have had if we'd held the NASDAQ. And really, they'll just to quantify what I mean by the diversity and participating with AI stocks. I looked at just now at one of our more aggressive accounts where people have elected to own only stocks and not bonds at all. This is rare. Most people want to have a balance, but our most aggressive account owns 5% of KWeb. So even then, we're never making a larger bet than 5% on anyone's account, even if they're asking us to be aggressive for them. So really, we learned from the past. AI is just another hot area. You notice that you don't own any cryptocurrencies in your accounts with us. We do not participate in fad-based investing like marijuana stocks. And we're not going to overweight AI simply because it's growing nicely. In fact, it feels expensive, and we want to be cautious there, and that's why we're looking to invest in AI in the least risky way possible, and we're finding that in China. Ethan, any comments on AI or to anything to add there?
Yeah, no, that was a really good summary. I think for us, everything really comes back to the institutional approach, which is managing risk, not only at the strategic level, but at the sector level and then at the position level. So meaning, how do we size each sector and each individual position properly to allow you to participate on the upside, but while managing risk. So as Al said, it's through KWeb because it's trading at a big discount to its US counterparts, but also through other ETFs that we have that are naturally exposed to the US market. So they would have exposures to the US technology space.
Great, thanks, Ethan. And we've had a second question here that I think is more in your camp because it's the day-to-day of asset allocation. And the question is, how often do you rebalance our accounts or change your portfolio allocations? It's a bit broad, so changing the portfolio allocations. Again, the question: how often do you rebalance our accounts or change your portfolio allocations?
Yeah, that's great. Yeah, great question. So I bring us back to what we talked about, which is our strategic and tactical asset mixes. When you think about it, your strategic asset mix is determined up front. And I said we could change it over time with age and changing life circumstances. But effectively, once you have your strategic asset mix set, it's meant for the long term. So you think about it, you have it set. And then as we see opportunities to either participate more in the market or reduce risk, we trade around that asset mix with our tactical techniques. So the frequency of changing the rebalance or doing the rebalance or doing a swap trade really is driven by two things, I would say. One is if you have a change in your circumstances that requires a change in your strategic asset mix. So an example could be maybe you want to, take some money out to do a project or buy a house. That could affect your strategic asset mix if that was a life-changing circumstance, or you received an inheritance and all of a sudden you're more willing to take on more risk and you have more capital to invest. That could potentially change your strategic asset mix. So those would be like life-changing events when we would initiate some sort of a big rebalance. On the other hand, though, if we see an opportunity, we could just take profit or add back to certain positions through a rebalance or through a swap trade. So really, it's to do with the context of those two types of asset mix, but also to do with your circumstances, plus what we see in the markets.
Thanks, Ethan. I think we've got time for one more question. We're coming up on the 45-minute mark. We were hoping to keep the event to under an hour. So one more question here that's just come through. What are your expectations for interest rates and inflation over the next year?
Go
ahead, Ethan. Well, okay, let me speak quickly. Yeah, sure. I mean, part of the point of this entire webinar is just remembering that we work in a world that is unpredictable. If we knew where interest rates and inflation were going, we would be able to invest, perfectly. But of course, we don't know where the stock market's going, the bond market's going. interest rates or inflation. We have indications, but we never know for sure. And that's really what, empowers us to make sure that we're well diversified and planning for everything, as best we can. If we spread things around, we know that we can be ready for any environment and especially surprises. And after a 28-year career, believe me, I've seen enough surprises that diversity is your friend. So Ethan, just wanting to see now, maybe see, I didn't answer the question, Ethan. So what are our expectations as best that from your research about interest rates and inflation? I know we had some announcements even today.
Yeah, no, for sure. Great question again. The expectation is that interest rates on the short-term interest rates will continue to come down a bit. So even this afternoon, we had the Bank of Canada as well as the US Federal Reserve cutting their short-term interest rates. So the expectation is that the central banks will continue to cut one more either at the end of this year and leading into next year, with the hope of supporting the economy. The labor markets are weakening, so they would, be able to cut interest rate, in effect, reduce the friction in the economy, in the machine, so to speak, in order to support the labor market. So the expectation is short-term interest rates will continue to come down a little bit. Inflation, on the other hand, appears to be a bit more sticky than they wanted. So, the central banks have a 2% inflation target. Right now, it's kind of hovering around 3%. And, having tariffs around is not helping their cause. Tariffs, are expected to be like a one-time boost to inflation. So the central banks are watching that very carefully. And it seems though that the trend is coming down slowly, but it's maybe going to take more time than they expected because of the tariffs. So overall, the takeaway is that the move on the short-term interest rates will continue to be lowered over time, at least into next year. And that in general is supportive of assets such as the stocks and other things. So we expect that with that tailwind, so to speak, markets will continue to be fairly robust and resilient.
Awesome, Ethan. Thanks so much. I'm not seeing any more questions in the chat, so I think we're going to start our wrap up here. I just want to emphasize just how important this asset allocation and creating a smooth ride are for our clients. Whether you're in the accumulation phase where you're trying to build your nest egg for retirement, you need to have knowledge of that consistency so that you can just keep adding to your portfolio without the aspect of timing, knowing that I sometimes say that we're your high interest bank account. Just keep adding and adding and adding, and the compounding will work. Or if you're in the decumulation phase where you're retired already, you need to know the consistency of your portfolio will support your spending for the rest of your life cycle. Or if you have goals to leave wealth to your next generation, can you plan for that? And so the consistency really is your friend. We find it is best practices. That's what we're striving for, and it's essential for your success. So with that, I'm going to pass it back to Ethan to wrap up officially for the evening. Do enjoy that baseball game if you've got it on record, and we look forward to the next webinar that we hold to continue to educate and inform. So have a great night, everyone. Back to you, Ethan. I'll say goodnight from here.
Great, thank you. I just wanted to end off by saying thank you for spending your night with us. We hope you enjoyed the content. And once again, we're your pilots, you're our passenger. So as financial advisors, we're always looking out for your best interests. And thank you for your trust. Have a great evening. Enjoy the game. We'll see you next time. Take care.